Welcome to the Deep Dive. Today, we are taking a really close look at the world of venture-backed finance as a service.
Right, FAS.
Specifically, those providers, the ones based out of Silicon Valley that are targeting startups all over the world.
And it's a crucial deep dive because we've seen sources that are really starting to question the big claims these services make.
What's the core tension here?
It's always speed versus accuracy. I mean, startups need fast, cheap financial infrastructure. That's a given. But we have to scrutinize three things. First, are they really giving you more accurate financial reporting? Is it really U.S. GAAP compliant?
Okay.
Second, how reliable is their local tax expertise, across North America or Europe? And then finally, are the financials they produce actually cheaper and easier for management to understand?
Exactly. So our mission here is to cut through all that marketing and figure out if this FAS model, which is, it's designed for massive scale and low cost,
Right.
is it potentially creating misleading reports about profitability while at the same time maybe sidestepping some really necessary local compliance?
To really unpack this, I think we have to start with the baseline. What's the normal, simple accounting practice for a brand new company?
Good place to start.
What's fascinating is that simplicity almost always wins in the early days. Most small businesses, especially, service companies or pre-revenue startups, they usually run on cash basis accounting through the year.
Why that?
It's just incredibly straightforward. It directly mirrors your actual cash flow. Money comes in, money goes out. You can track it cheaply and easily just using your bank and credit card feeds.
And that simplicity, that's a survival tactic when every single dollar counts.
Absolutely.
But we know that as soon as a company wants outside investment or hits a certain size, that cash basis just won't cut it anymore.
No, it won't. They have to move to the accrual basis. That's what's required under generally accepted accounting principles or U.S. GAAP.
Or IFRS if they're operating internationally.
Right, international financial reporting standards. And that transition is where all the complexity starts to creep in.
So just to be clear for everyone, cash basis is
Simple. Revenue is recorded when cash is received. Expenses are recorded when cash is paid.
And accrual.
Accrual is the gold standard. It records revenue when it's earned and expenses when they're incurred, and that's regardless of when the cash actually moves.
Okay, so if the cash basis is so much easier and cheaper for just running the business day to day, how do traditional local accountants handle that GAAP requirement? Without forcing the startup into a really costly and complex accrual system every single month.
Yeah, that's the key. They use a really strategic and cost-effective hybrid approach. They keep the books on the simple cash basis for the day-to-day stuff, and then once a quarter, or more critically, once a year.
But year end.
Exactly. At year-end, they perform what are called cutoff procedures. This just means they make a few specific adjusting entries to switch the statements over to the accrual basis, but only for that external reporting period.
That makes so much sense. It's like a targeted surgical intervention instead of a full-body transplant.
That's a great way to put it.
So can you walk us through what those big year-end adjustments are? Because this is precisely the work these FAAs providers claim they do better, but all year round.
Absolutely. There are really four main areas that separate cash from accrual. First is accounts receivable, or AR. That's the money that's owed to you for sales you already made or invoices you sent out before the year ended, but you collected the cash after.
Got it. And the flip side of that would be accounts payable.
Exactly. AP. The money you owe for expenses you've already incurred, like a bill you received from a vendor, but you haven't paid it yet.
So AR and AP are about making sure the report accurately shows who owed you and who you owed on that specific balance sheet date.
Precisely. Then you'd also look at, inventory if you have it, and critically, adjustments for things like prepaid expenses or unearned revenue.
Okay, what do those cover?
They deal with cash moving ahead of the service. So think about paying your annual insurance premium in January. That's a prepaid expense for the whole year.
Right, you haven't used all 12 months of it yet.
Or receiving a big retainer from a client for work you haven't delivered yet. That's unearned revenue. These adjustments just match the economic activity to the correct period.
This whole cash adjusted to accrual model, it's not just simple, it's also really strategic for tax, right? Especially in the U.S.
It is hugely strategic. For an early stage company, it's all about balance. Under U.S. tax law, most small businesses, and we're talking about those under a pretty high gross receipts threshold, it's around $30 million for 2024. They are actually allowed to use the cash method for their tax filings.
on their Form 1120S or Schedule C.
Exactly. So this simple cash-adjusted method is not only adequate for basic reporting, it's often strategically better for managing your tax bill. It really hits that sweet spot of simplicity and compliance.
And if we pull the lens back, the sources point out a really sharp contrast when we just look north to Canada.
Yes, Canada is much, much less flexible on this. They pretty much mandate the accrual method for income tax for almost all businesses.
Really? So no cash basis option?
Almost none. The cash basis is reserved for very specific statutory exceptions. We're talking farmers, fishers, and certain self-employed commission agents.
Wow.
But service companies, tech companies, retailers, they all have to use accrual for tax. It often forces Canadian startups to adopt a full-time, more complex accrual system way earlier than their U.S. counterparts, no matter their size.
Which just shows that a one-size-fits-all FAS model has to deal with these hyperlocal rules right away, or it's going to risk noncompliance.
Immediately.
Okay, so we've established the simple way is cheaper and totally fine for U.S. tax. So let's get to the core critique. Why are these venture-backed FAS services pushing for the much more complex, road-immediate, full U.S. GAAP adoption, if that hybrid approach is cheaper and perfectly acceptable? The sources seem to suggest it's all about the optics of profitability.
And that's where the tension really becomes acute. The sources argue that some of these FAS specialists are using what one source describes as a caricature of U.S. GAAP.
Caricature?
Yes, a caricature of U.S. GAAP, specifically to rationalize really aggressive expense deferral.
Hold on. If they're claiming it's GAAP, how can it be a caricature? I mean, are we talking about accidental mistakes here, or is this more like strategic manipulation to boost the short-term numbers? That's a huge distinction for an investor.
The sources are definitely leaning towards strategic manipulation. The whole point of accrual accounting is to accurately match your revenues and expenses.
Right.
A common way to inflate profits in an early-stage company is to be overly aggressive in capitalizing expenses.
Meaning you classify things that should be immediate operating costs as assets on the balance sheet instead.
Exactly. Things like certain internal software development costs or maybe the implementation fees for a big annual software subscription.
And by capitalizing them, you push those expenses off the income statement for now, and then you just spread them out over years as depreciation or amortization. It's an instant paper profit boost.
That's the move. And the consequence is immediate. It increases the apparent EBITDA, the apparent net profitability, and it makes these young companies look significantly healthier and more scalable for their next funding round.
So the sales pitch is, we're just moving you to proper GAAP reporting, but the actual execution might be serving a very different purpose for fundraising.
One could argue it's a self-serving purpose.
And the cost comparison here is pretty damning. It suggests this approach is actually counterproductive for the management team itself.
Absolutely. The sources say that the traditional cash basis adjusted to accrual method used by local firms is probably much cheaper, and critically, it's much more easily understood by the founders. When you try to force a really complex, potentially distorted GAAP system onto a small team, you just create confusion. They stop trusting their own numbers.
So let's say a startup goes down this path. They adopt this potentially flawed version of U.S. GAAP. What's the risk to their investment prospects later on?
It creates a complete nightmare scenario. A poorly implemented adoption of GAAP, or IFRS for that matter, is going to cost way more money and time to fix when serious due diligence finally starts.
So you're the CFO who suddenly has to unwind 2 years of this caricature GAAP right before a Series C or an IPO process.
It would be a catastrophic distraction, a total mess.
And the ultimate irony is that for those early stage rounds, that simple cash-adjusted statement might actually be more credible to a savvy investor.
I think it is. We would argue that a full, rigorous move to complex U.S. GAAP really isn't necessary until a company is much closer to a serious exit event like an IPO. Adopting this caricature can actively scare off legitimate institutional investors, the ones who prioritize transparency and reliability over, overly optimistic historical profits that are just based on aggressive accounting tricks.
The goal is accuracy, not just juicing the numbers for the pitch deck.
That's the bottom line.
That is a powerful critique of the accuracy claim. Okay, let's shift gears. The second big issue, compliance and reliability. How much should a startup really rely on a low-cost, Silicon Valley headquartered FAS for complex local tax issues across North America or Europe?
So this moves us from a reporting risk to a compliance risk, which, often carries much harsher financial penalties from governments.
Right.
FAAS excels at high-volume global transaction processing. That's its strength. But that model is inherently disconnected from the hyperlocal, complex, and constantly shifting tax and regulatory rules of all these different jurisdictions. Tax law is, by its very nature, local.
So what are the specific compliance risks that startups are facing if they outsource all of their high-level compliance? I'm thinking state taxes in the U.S., VAT in Europe, to an offshore FAS team.
Well, the number one risk is just a lack of specialized local knowledge and, frankly, qualification. An offshore FAS team might be brilliant at using QuickBooks or NetSuite, but they often lack the qualified local tax professionals, a U.S. CPA for state tax nexus, or a UK chartered accountant for UK corporate law.
People on the ground who know the local system.
Yes. People needed to handle state and local income tax filings, European VAT rules, e-invoicing mandates. All these laws change constantly, and you need active monitoring by qualified local experts.
And that complexity, I imagine, just multiplies exponentially once a startup begins operating across borders.
Oh, it absolutely does. Then you face two huge cross-border risks that these FAAS models are just poorly equipped to handle. The first is something called permanent establishment, or PE.
PE risk, what is that?
It's a crucial tax concept. It's when your business arrangement inadvertently creates a taxable presence for your company in a country where you thought you were just, a remote seller.
So the way your service team operates in a foreign country could cross some local threshold.
And suddenly, your startup owes corporate tax and has to register in that country, creating a massive, unexpected liability.
Yeah, that is a big one. What's the second major risk?
The second one is transfer pricing. We hear this term thrown around a lot.
Right. How does this apply to a young startup using a global FAAS?
Transfer pricing governs all the transactions between related parts of your company. Say, between your U.S. head office and your UK subsidiary. Those transactions must be priced as if they were done between two independent parties. It's called the arm's length principle.
And why would an offshore FAAS team likely mess this up?
Because meeting transfer pricing rules requires detailed, what's called contemporaneous documentation that justifies your pricing method. It's complex. It requires specialized economists or tax lawyers, not high-volume bookkeepers. If your documentation is poor or just non-existent, it leads directly to audits, huge penalties, and the risk of double taxation.
Being taxed on the same profit in two different countries.
Which can cripple a young company. This is highly specialized compliance work that has to be overseen locally.
This gap in hyperlocal tax expertise, it brings us to that really striking anecdote from the sources about the FAS leadership profile. The profile of a VP of finance for a global FAA service, one claiming over 1,000 employees, is quite revealing.
It was very telling, yes. This executive had a respected CA designation, a chartered accountant earned in India, but then you look at the subsequent North American experience.
Where most of the clients were based.
Right. That experience was extremely limited. It included only a 2-month stint at a Canadian CPA firm in Ontario, followed by a couple of short controller roles.
A 2-month stint. So, the question's obvious. How does 2 months of exposure to Canadian accounting standards prepare someone to lead a complex, global, high-stakes tax compliance strategy for a huge provider?
It underscores the whole priority shift we've been talking about. In 2 months, you gain zero practical knowledge of, say, nuanced provincial sales tax remittance in Ontario, or how Canadian tax residency rules apply to remote workers.
The very things that protect your clients from PE risk.
Exactly. This profile just suggests the leadership's focus is almost entirely on scaling the high-volume processing and efficiency models, not on ensuring deep regional tax competence. The risk is just passed on to the client.
So what does this all mean for a startup founder who's listening right now? If FAAS is cheap for the day-to-day stuff, but risky for tax and potentially misleading for profitability, what's the mitigation strategy?
Complete reliance on FAS for your high-level tax compliance and complex reporting is generally a false economy.
A false economy.
You might save some money on basic processing, but you expose your company to catastrophic audit and penalty risk. Or worse, you fundamentally mislead investors about your true financial health.
So a very carefully designed hybrid model is the only real way forward.
Absolutely. You have to use FAS strategically, outsource the high-volume, low-risk, repetitive transactional work.
The data entry, the GL maintenance.
Basic payroll processing, yes.
Yeah.
That is where they truly deliver cost savings and efficiency.
But the startup has to maintain a firewall around all the high-risk activity.
Precisely. You must retain local oversight. And that means hiring a local, highly qualified tax partner or an in-house controller in your home jurisdiction. They handle all the complex and high-risk compliance. That includes the final preparation and signing of corporate tax returns, handling international issues like transfer pricing, navigating VAT and sales tax registration, and managing any audit preparation.
So the bottom line is still, despite all the promises of global FAS, the complexity of hyperlocal tax law still demands expensive, specialized expertise right in your home jurisdiction.
That local knowledge is not a luxury. It's a necessary insurance policy against devastating compliance errors.
Yeah, that seems to be the essential takeaway. This has been a really necessary deep dive into the FAS ecosystem. So to quickly recap the key findings, that simple cash-adjusted to accrual approach, it remains the most cost-effective and understandable system for early-stage companies.
Right.
The full-blown FAAS model might introduce unnecessary complexity and some risky profitability claims through a distorted implementation of U.S. GAAP. And critically, an offshore FAS should never be completely relied on for complex local tax compliance. You just need that hyper-local qualified expertise.
And this raises, I think, a final important question for you, the listener, to think about. Considering that some of these FAS models seem to prioritize a caricature of U.S. GAAP, specifically to increase apparent profitability by aggressively deferring expenses, what does that reliance on potentially manipulated historical reports imply about the quality of the data that venture capital investors are looking at when they make their multi-million-dollar funding decisions? It suggests that maybe the simplest financial statements, the ones proven by actual bank balances, may still be the most trustworthy, something for you to mull over.